Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. Shares of Air Canada are soaring today after the national airline posted higher than expected revenue and profit in its fourth quarter. Air Canada says the results were driven by growth in domestic and Atlantic travel, which offset weakness in travel between Canada and the U.S. There was also decent demand for cargo transport. Magna International, the best performing stock today on the TSX. It's up 19% today, almost 20%. The auto parts supplier boosted its revenue and profit forecast for the full year after beating on the top and bottom lines in its latest quarter. Magna now sees revenue of up to $43.5 billion U.S., despite the decline in global vehicle production. Shares of Hydro One trading higher today after posting fourth quarter profit and revenue that beat estimates. The Canadian electrical utility says it's partnered with First Nations communities and secured the necessary funding to begin work on the Chatham to Lakeshore transmission line. The CEO says the project is the first to be developed under a 50-50 equity model, calling it a meaningful step towards reconciliation. U.S. consumer prices rose less than expected in January. Data from the U.S. Bureau of Labor Statistics shows underlying inflation firming as businesses raise prices to start the year. Looking ahead, economists expect inflation to pick up as dollar depreciation and the pass-through effects of import duties continue to weigh. A bit of a comeback today for the North American markets, starting with the TSX here. It's up 499 points, or 1.5% after the down day yesterday. It's sitting at 32,965. Across the border, not a material move for the S&P or the Dow Jones. The Dow down about 25 points right now. The Nasdaq has dropped 75 points, down about a third of 1%. Agnico Eagle is now the world's second largest producer of gold, beating Barrick Mining. Agnico Eagle shares are higher today after the company just recently reported results. So let's welcome Ammar Al-Joundi, President and CEO of Agnico Eagle Mines. Thanks for joining us today.
Thanks, Morella. Nice to be here.
3.45 million ounces mined last year, but you were down in the last quarter for production. What led to that?
It's really just mine sequencing, Morella. It's the nature of where the grade in the mine at any point in time. So the costs were good. Cost per ton was good. It was just grade and mine sequencing.
Okay, you say the payable gold production forecast will be in the 3.3 to 3.5 range for the next 3 years. What leads you to that assessment?
Well, these are mines that we've been operating for decades in regions that we know well. We have a very high level of confidence in these mines.
That's it? Just confidence in the mines?
Yeah. I mean, these are not brand new operations. These are mines that we know well. Our teams are the best in the world when it comes to operating those mines. I think the real story is going forward, where we see a step change to over 4 million ounces starting early in 2030s and closer to about a 20 to 30% overall increase over the next decade.
I did see that 20 to 30% in gold production increase. Yeah. So where is that coming from?
That's coming mostly, Morella, from expanding some of these great mines. So let's take a look at that. Detour, which is Canada's biggest mine, we see that growing from about 700,000 ounces a year to about 1 million ounces a year. Canadian Malartic, Canada's second biggest mine, we see that growing from about 550 to about 1 million ounces a year as well. Now, to put that into perspective, in the entire world, there's only 4 mines producing 1 million ounces a year or more, and only one of them is in the Western world. So when these two, which are already Canada's 2 biggest mines, when they hit 1 million ounces each, Agnico will have 2 of only 3 mines in the Western world producing over 1 million ounces a year.
Wow. All right. You've acquired Yamana Gold and Kirkland Lake gold assets. Can you give us a bit of an update then on both?
Well, the merger with Kirkland Lake, that came with Detour, and Detour is the mine I just talked about. getting to 1 million ounces. And interestingly, Yamana, when we acquired the Canadian assets of Yamana, that was the other half of Malartic, the other mine I talked about. So it's a good opportunity to mention that we've really created an awful lot of value through those mergers and acquisitions, in that a large part of the growth is coming from those two world-class mines. And it really reflects how Agnico is able to acquire something at one level and then really bring it up to a much higher level.
Let's talk about the price of gold, which has skyrocketed over the past couple of years. Obviously, you've benefited from that. What happens if there is a drop in bullion?
Well, we are already the lowest cost producer of our peers. We already operate in the safest jurisdictions. So, while we're benefiting exceedingly from the increase in gold price, just to put it into perspective, Marilla, year over year change in gold price is up $1,700. Our costs are up $76. So over 95% of that gold price increase, we've been able to deliver to our owners. And that's kind of the whole point of being in this business. That said, we are the lowest cost producer of our peers. We have $3 billion on the balance sheet. We have no net debt. So we're in really a strong position, even in a downward gold price environment. But again, importantly, able to deliver all that upside, not just upside in the gold price, but as we grow our production, we're actually going to create more gold per share for our owners.
Okay, so let's talk about buyback plans. I'm wondering if you plan to accelerate that, all things considered.
I think that at these gold prices, you can expect a likely increase in the buyback over the year.
Any indication of how much?
Well, we're looking to increase our normal course issuer, our buyback limit to $2 billion.
Okay. Let's talk about silver and copper, which you produce as well. Can you give us an update on both of those and how that has benefited you over the last year?
Those are pretty small in our portfolio. We're about 97, 98% gold. So while they do benefit us and in particular have an impact a little bit on the net cost, we really are the most gold-centric of any of the senior gold mining companies.
Okay, so let's take a look ahead to 2026, 2027. You talked about the production that you expect. After that, you expect it to be even higher, 20 to 30% higher from two of your major mines. What are the challenges you're looking at in the next 1 to 2 years?
Well, first of all, let me say that the growth is going to be more than just those two mines we talked about. We're building a new mine in Ontario. We're looking to announce building a new mine in Nunavut. That mine alone will be over 400,000 ounces a year. We're looking at building a mine in Mexico, a copper mine. So we've really got a lot going on. So the growth is broad-based. With regards to risks over the next couple of years, again, we have reliable assets in reliable regions. We've been operating there for decades. Clearly, the biggest risk is gold price changes. But as we talked about, we're very well positioned for that as well.
Do you think it's jurisdiction then that has mostly held back Barrick Mining, which was number 2 for production, which you have just ousted?
Well, I don't really want to talk about our peers. I mean, I know the people at Barrick quite well. They're good people, and they're working on different strategies. They are looking at separating their North American assets from the rest of their assets. They're smart people. They'll figure out what to do. Any
acquisitions coming up on your calendar?
We always look at everything. That's part of our job. We get paid to look for opportunities to invest our owners' money. But what I would say is, we will only do acquisitions if it creates additional value per share. We're not interested, Marilla, in just getting bigger for the sake of getting bigger. Our job is to create value per share. So any M&A that we would look at has to do that.
Ammar Al-Joundi, appreciate your time, sir. Thanks for joining us. Mr. Al-Joundi is President and CEO of Agnico Eagle Mines. Volatility, the key word that comes to mind for the week, with tech continuing to soften. We'll take a deeper look at the market in just a moment. The key question for investors today is what is driving the stock market volatility? Let's go to Yuko Girard on that, Vice President, Portfolio Manager at Scotiabank. Thanks for joining us today. What do you think sparked that deep dive this week?
I think investors are getting a little bit concerned about the very high expensive valuation and some of the names that did very well last year. And, looking at the economy and thinking like, is there anywhere else that I could go in? Because the upside is getting limited on those names. And there's also this whole, talk about the capex and how much they're spending and how much that could actually improve their revenue or their profit margins. So a lot of concerns on those names that did well. And then, they're looking at other areas. The other volatility probably is coming from the AI impact and, outside of even the tech or software companies, like other areas that AI might kind of take over their business or really kind of impact them negatively.
Okay, despite the volatility, you do expect 2026 to be positive for the markets. What are you basing this on?
I think it's more on the economic indicators, and economic backdrop is pretty, solid. Like when we usually monitor a lot of the leading indicators, and whether it's the PMI or whether it's the GDP growth, and also inflation and labor. Like when we look at those, the actual numbers are actually better than a couple of years ago. So the recession risk for us is lower. Now, this is more tied to the earning growth. So the company is probably going to have a better or solid earning growth, but the multiples, this is where we don't know, because the investor sentiment can be, different than like you saw, that year to date. It is impacting the multiples, and that is impacting the price.
Okay, so what else would be a risk to growth in 2026?
I think, we saw good job data and inflation numbers from the U.S. This week, which was a good news. But if that changes and it actually is worse than expectation, which kind of leads to a different policy decision, that's one thing. The geopolitics is always going to be another, risk. And also we have these trade, it's still not done yet, right? Like tariff was a big, talk last year. We still see that coming, here and there. And so anytime those kind of a news comes up, I think it's going to add volatility. And depending on how it's implemented, and it can affect the market.
Okay, I know that you like materials and energy right now, but can you drill down on both for me, why you're looking where you are?
I mean, it doesn't mean I really like it. It's like in the TSX did very well last year, and the majority was really coming from the precious metal stocks. Given the, still the uncertainties and the geopolitical risk, I think those themes are continuing to do okay or well within the TSX. So given that, energy and material has done year to date fairly well, that will hold up the TSX well. But yeah, I don't really prefer that sectors, because it is not the best sectors to hold in for the longer term investors, and our active managers tend to be underweight in those areas.
Okay, we talked about investors' concerns about AI and what businesses are at risk. Investors clearly spoke about some of that. What AI exposed names do you see as winners in the longer run?
Yeah, I think this is the place where you really have to differentiate the high quality names and versus the more the if you look at the balance sheet, weak balance sheet, and you need to really kind of look at why they're being impacted and why the price is going down. And something like Microsoft, I know it was impacted quite negatively, especially after the earning release because of their capex spending. But I think those are names that are actually in the long run very good name and could be a buying opportunity right now because the prices went down so much.
Does that mean with some of the other mega caps you are diversifying away from them, or are you still holding some of the others as well?
It depends on the portfolios, but in general, we held those names, but we were never overweight on those names because we always wanted to diversify, and actually our diversified portfolios, especially in the U.S., is doing much better. And like equal weight versus the cap, market cap weighting index, you can see the equal weight is doing better. So I think the leadership is really broadening, and the diversification is really working. Especially like in the U.S., that's what we think in the 2026.
Okay, are there pockets, Hugo, where you think there are opportunities that perhaps investors are overlooking right now?
I think there's a lot of names in the industrials that really got punished last year because of the multiple reset, but they're really a good quality companies. And I think once they realize that, now that it's actually in a reasonable valuation, that those are the areas that can benefit from this broadening of the leadership.
When you are talking about diversifying out, as you mentioned in the U.S., what are you diversifying to?
I think there's a lot of areas like I said, there's industrials. Consumers, we need to be a little careful because we saw some not too good retail numbers. I think consumers still buying, but there's this K-shaped economy in U.S. where the lower income consumers are struggling, and even though inflation is now kind of under control, it's still everything is already expensive. So consumer discretion is an area that probably is not the best area, but even like the staples, like it's very defensive in this kind of volatile market. Maybe it's not a bad place to actually put some money in.
Got it. Hugo Girard is Vice President and Portfolio Manager at Scotiabank. Thanks for your time.
Thank you.
Up next, shares of Enbridge and TC Energy up today after the Canadian pipeline companies reported better than expected earnings for the fourth quarter. We're back in a moment. Shares of both Enbridge and TC Energy were on the move today after both companies exceeded fourth quarter earnings expectations. Let's go to Aaron McNeil, research analyst at TD Cowen, for more on this. Thanks for joining us today. Enbridge, of course, benefited from lower taxes in the U.S., but what else?
Yeah, I think, from an EBITDA perspective, it was relatively in line. Like most segments were right along where we expected. I think, if we're bringing it back to the share price reaction today, I think it's more a function of the growth outlook. Like just broader sector themes are very positive for Canadian midstream. Enbridge is no different. They did announce 2 renewables projects with the quarter, 1 wind, 1 solar. And that's kind of interesting in terms of the U.S. tax credit landscape, which the tax credits are expiring, so you need to have projects in at least starting mid this year or ending by the end of next year in order to qualify for those tax credits. So we're seeing some growth there. I think the other big thing from the quarter was that they increased their sort of capacity of spending per year. So how much growth capital can they spend per year? And it used to be $9 to $10 billion, and now it's $10 to $11 billion.
Interesting. Okay, so you think they rushed renewables a little bit to get the benefit of the tax credit. They're an energy delivery company. They do pipelines, but how exposed are they to the price of oil, which we know has been suffering?
Yeah, so no direct price exposure. They'd be 98% take-or-pay contracts or cost of service contracts, so very highly contracted business. They where they have sort of exposure would be on volumes of their mainline pipeline. So let's say if production was down in Canada, mainline volumes could theoretically be down, but we've actually had apportionment is an industry jargon term, but ultimately means how much more supply there is than capacity. And so Enbridge mainline was over 20% apportioned in February, meaning there was 20% more oil that wanted to flow through the system than they could take on. So again, I would go back to fundamentals, incredibly strong for Enbridge on that front.
Okay, the company also has a backlog of $39 billion, up from, I think, $14 billion the previous year. Can you tell me a little bit about what that is for them? Is it just generally infrastructure build out, and how much would be from the U.S.?
Yeah, I mean, they would be firing on all fronts. I don't have it handy off my fingertips, but it would be a lot of U.S. for sure. U.S. gas, certainly a big piece of it, not only on the gas transmission side, which is probably the biggest wedge. They also would have a lot on their gas utility business. But even in the liquids business, I mean, they're doing, a lot of work on the main line. They recently announced mainline optimization phase 1, which will expand the pipeline by 150,000 barrels per day. So there's opportunities across the spectrum.
Remind me also how they're part of the AI build out. I know they do have a contract, and what kind of revenue comes in from that, or do they expect from that?
Yeah, so I think the way to think about the AI build out in the context of Enbridge, I would maybe take a step back and think about power demand. And so they sort of access the power demand market through a couple different avenues. One would be their gas transmission business. Obviously, natural gas, has both the check marks of sort of reliability and affordability. They would also have, the gas utility business, which would address that market separately. And then they have the renewables business. And again, like I think it was the wind project today that the counterparty was Meta. So again, they're accessing that market through multiple different segments. Okay,
I do want to ask you quickly about a new pipeline. There are discussions about a new pipeline in Canada. I know they've mentioned it before. What are you hearing lately from this company about whether or not it wants to be involved in that?
Yeah, they've been pretty consistent in that they are not involved in that that pipeline today. It didn't sound on the conference call like they were more willing to participate than previous commentary. I think what they said, and I'm paraphrasing on the conference call today, was that they feel as though oil wants to flow south, not west. They feel as though the main line and expanding the main line is the most cost-effective and path to sort of providing egress for customers. You didn't bring up Venezuela, but obviously there's some concerns around competing in the Gulf Coast refining market. Enbridge addressed that on the conference call as well, suggesting that the heavy oil refining capacity may grow in the near term. They also talked about opportunities to export crude oil off the Gulf Coast, Canadian crude oil off the Gulf Coast. So again, I think they're sticking to their sort of plan, which is to expand the main line.
Okay. 30 seconds or less. I'm sorry I've cut the time short, but TC Energy, not a lot of new projects happening. Give me a little bit about your thought on that.
Yeah, not a lot of new projects today, but they were pretty clear that there's going to be a lot coming in the near future, and they said weeks potentially. So I think you're going to see the cadence of project announcements increase pretty materially over the next several quarters.
Got it. Aaron McNeil, got to leave it there. So thank you so much for your time. Really appreciate it.
You bet. Thanks.
Let's have a quick look at the markets ahead of the break and the end of the trading day and the end of the trading week coming up. So the TSX up, everything else dropping down today. We'll give you the closing numbers when we come back. Here are the closing bells for the end of the trading day, the end of the trading week. At the NASDAQ, Crown Crafts ringing the closing bell. And in New York, Iris Acquisition 2 ringing the closing bell. For the TSX, it's BlackRock Canada ending the week. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX recovering today after losing yesterday, so it's back up 608 points today, or 1.9%, at 33,073. No record here, but above 33,000 again. The S&P did not make a big move either way. It's up 3 points on the day, and the NASDAQ dropped 50 points, or about 0.2%. Let's get to the movers in Toronto. Magna, maker of auto parts, up today 18.9%, so almost 19%. They've got a forecasted steady sales growth for 2026. We're going to bring more details to that story with Stephanie Hughes in just a moment. Trisura, also a winner, Trisura Group, up 11.5%, or $5.14 on the day. after beating expectations in their latest quarter. G Mining Ventures also up today by just over 11%, gaining $4.89 a share. And then in the red today, Colliers International dropping about 3.4%. The biggest loser on the TSX today, the real estate company, reported profit that came in below expectations. Advantage Energy also down today, and it actually is down more, 5.5% or 63-cent drop. $10.78 is where the stock ended out today. The firm announced the conclusion of a strategic review process, said they have failed to find a buyer. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now to talk some more about the movers. Stephanie, talk to me about investors embracing Magna's results. What led exactly to that spike?
Yeah, that's right, Marella. Happy Friday. So Magna International, it was a big embrace by the traders. In fact, moved the stock price up as much as 21% at its highest point today. That marked its biggest intraday gain since March 2020. So almost 6 years since we've seen a move of this magnitude. And in fact, it was on track to close at its highest or with its biggest gain since 1991. And I think it pretty much achieved that since the markets closed. It also brought the stock price to its highest level since February 2022. And as to what led to this gain, the auto parts supplier company reported adjusted earnings of $2.18 per share. That came well ahead of what analysts were expecting. But more importantly, as you alluded to, it was the guidance that the company issued. They boosted their full year sales forecast, now expecting as much as $43.5 billion in sales for the entire year. That's really coming ahead of what analysts were expecting, and really giving them an impressed tone for the company, including Evercore ISI's Chris McNally calling it a monster quarter for Magna, and that of all the supplier upside surprises that he's been seeing in this reporting season, Magna was probably the biggest one. We also had TD Cowen's Brian Morrison weighing in, saying that Magna is well positioned in to see further upside in an industry that is getting a bit better outlook lately. Recall that this time last year that the trade talks, there's a lot of trade angst, a lot of tariff talk that was kind of sending some jitters through auto suppliers, but the share price has held up for a lot of them, including obviously Magna, which those shares are up by over 27% last time I checked on a year-to-date basis, putting it well ahead of other competing suppliers in Canada like Linamar and Martin Rea. So it's been a good showing for Magna, Marella. Okay, let's get to Colliers, which dropped today. Can you tell us a little bit more about what is going on with the real estate firm? Sure thing. Yeah, it's a different story for Colliers. Obviously, that share price moved in the opposite direction by down by over 15% at its lowest point, which was its biggest drop since May 2023. And it spent most of the trading day today as the worst TSX performer. It looks like it closed the day being at the bottom of that list. And the problem here was that the real estate firm's fourth quarter results were just a miss compared to what analysts were hoping to see. You had the National Bank financial analyst team saying that the earnings miss was primarily driven by engineering and investment management businesses. And that's despite a strong showing and a beat in its capital market segment. So a bit of a mixed quarter, but analysts and traders alike, apparently, as you can see in the price, really not impressed with the fourth quarter showing here, Marella. All right, we will leave it there. Stephanie Hughes, thanks for the update. Have a good weekend. You too. Coming up next, this week, the tech sector saw that pullback. Investors still have concerns about AI and integration. We'll break it down when we come back. No big recovery today for the American markets after a deeper dive this week. Our next guest says the sell-off has been an overreaction. Let's go to Lisa Schreiber, Associate Portfolio Manager at Gradient Investments. She joins us now. Lisa, thanks for joining us. On the software threat, you say there is merit to some of the concerns, I guess. What businesses do you see at risk?
Yeah, I mean, it was a tough 2 weeks so far in the markets, especially around AI, right? I mean, it all started off with Claude coming out with their new AI assistant that ruffled some feathers with, especially with the traditional software as a service companies. But by now, it seems no industry got spared, right? We then had more reports of Altruist, for example, coming up with a tax planning service, which ruffled some feathers for wealth managers. Then we had also spilling over into real estate. We had it also seeing yesterday with trucking and freight companies, which are more traditionally more old economy sectors who were seen so far to be a little bit more spared about the whole AI frenzy. And I think overall there's a lot of headline news out there, and investors are generally more nervous, right? I mean, given like the whole AI disruption fears, the whole AI capex spend that just seems to go nowhere but up, and also the returns on investments that are not as clear yet as some advisors wanted to see, then we also see that investors are acting first and selling first in that case, and asking questions later. And again, I think it's all very much overblown through the roof here, but there is some merit to it. I mean, given all the sophistication of these AI models where we are right now, right, it can make some of these traditional software as a service companies and all of that obsolete over time, and there will be for sure winners and losers. But again, I think the most important thing to mention is here, this will not happen overnight. This will not be adopted broadly overnight. And for now, it creates certainly great opportunities for buying some of these quality names that were beaten down pretty dramatically.
Okay, I want to talk about the quality names you pick up in a moment, but I'm wondering, I know you're saying adoption will take some time, but should we expect more disruption soon? Since, as you mentioned, we're seeing so many now of these products come out, boom, boom, boom.
Yeah, definitely. I mean, it started again with software. It ruffled some feathers and all of that. But I think these companies, first of all, and there will be winners and losers, and there will be some that will be obsolete. But I think I want to give an example here. With Google, for example, it was a longer laggard within the Mac 7. At first, when OpenAI came out with ChatGPT, investors put basically Google and Alphabet to the dead, saying, okay, it will disrupt their search business. It will become obsolete. Company will have no future over the long run. And then what we saw last year, Google came roaring back, right? Their search numbers are doing very well. They came out with their own AI model, Gemini, which is also doing fantastic. And now it's the leader of the Mac 7 cohort, right? So these companies obviously have to step up their game, have to find new ways to create revenues, have to find new ways to implement that going forward. So that is certainly needs to happen there. But I think overall, it's very, very helpful to disperse a little bit here of what is really happening and when it's happening. And again, that's not happening overnight. And we see a lot of these headline numbers and headline tools coming out here, which is certainly a big disruption. But I think overall, this will create opportunities to snatch up some of those beaten down names and then wait for it.
Which ones would you pick at today?
We still very much love Microsoft. I mean, Microsoft was one of the beaten down names here. Palo Alto Networks as well, right? Strong in cybersecurity. I mean, these businesses are very well set up. Their fundamentals are totally fine. They reported great earnings, right? Nothing is wrong with that. They just caught up within all of that frenzy. And I think that would be a good entry point here of some of these quality names that will probably do very well going forward.
Are there other sectors that you see are suffering for no real reason?
I think, as I mentioned before, wealth management got beaten down dramatically after Altruist came out with their own tax estate planning AI tool. And we saw Schwab and Stifel and Raymond James, all of these traditional wealth managers pretty much sold off. And I think there is that was overblown as well. We saw that, and I think you can still remember that a couple of years ago with the first robo-advisors when that all came out. And I don't know of what iteration we are, robo-advisor 3.0 or 4.0, in what iteration we are, but it was not as bad as expected at the end of the day for these traditional sectors, right? Because as long as people do not want to hand over all their assets and all their finances to AI and to those robots, so to speak, as long as we still need humans there, as long as these sectors will be doing fine going forward. And that's just one example in one sector here where I don't see disruption. obviously, but I don't see these sectors going anywhere soon, and these names will probably very well do fine going forward.
Some of the movement away from AI and from software began late last year, but it really has picked up more recently. Do you expect this kind of volatility then to continue this year?
Yeah, like you said, I mean, we saw some broadening out and market rotation starting actually at the end of last year, and then coming into this year, intensifying with we see more small cap participation, which is great, and we see just a broader participation of value stocks, more the picks and shovel and more the old economy sectors, right, coming up. And I think overall there is higher volatility, there is a lot of nervousness, and it doesn't feel comfortable right now. But overall, I think it sets us up for a healthier market going forward, where we see strong leadership beyond just the 7 or 10 large names, right? And I think that sets us up for just a more diversified approach and just a more diversified return profile going forward. And I think that can be sustainable right now.
Okay, Lisa Schreiber, going to leave it there, but thank you for your time. I appreciate it. Coming up next, there are signs that U.S. inflation is easing. January CPI report showed a slower than expected increase in the cost of goods and services. More in a moment. The cost of goods and services in the U.S. increased at a slower annual rate than anticipated for January. Let's go to Oscar Munoz on this, Chief U.S. Macro Strategist at TD Securities. Thanks for joining us today.
Thank you.
This period would include the government shutdown time. Now, if they didn't collect data in that period, would that throw off the number they came up with for January?
No, I don't think so. I think this is one of the cleanest reports that we've gotten in a good while. I think you can raise some questions for the November data and perhaps December, but I think January was pretty clean. So I probably take the signal from this report fairly straight. I don't think there are a lot of blemishes on it.
Okay, let's talk about what came in. Prices were down pretty much across the board, but there's an exception for transportation, for example. Any reason why?
Yeah, I mean, airfares were pretty strong. It's usually a very volatile segment. So it goes up and down depending on the month. So I wouldn't take a lot of signal from it. I think the main signal, I guess, the main takeaway is that if you wanted to see evidence of disinflation, I think you can find it in this report. We're looking for a stronger print for the core in particular, but services inflation, even with that strong transportation segment that you're mentioning, just came in softer than expected, right? Also, if you look at core CPI inflation on a non-seasonally adjusted basis, it was the weakest month-on-month print for any January since 2021. So we're basically back to the pre-pandemic pace, and that's good news at the start of 2026. So some green shoots in the report today.
Okay, let's talk about food prices for a moment, if you don't mind. They do appear to be easing, and I know grocery prices generally have been on the rise across North America. Was that a surprise to you?
It was a little bit of a surprise, yes. I think food prices in general, the whole segment was a little bit of a surprise. For us, it was mostly food away from home. We're penciling in a stronger increase, but it actually came down, and that's the prices associated with food services spending, restaurants, right? So that's good in terms of the thesis that maybe the labor market is not overheating, and you see that through the recent disinflation in that segment. So I think in terms of services, it's good news, and this is going to show up even more in the core PCE number that we're going to get for January.
Okay, so let's talk about tariffs, because many people thought that some of the tariff pass-through would be happening now, the start of the year, maybe that the people who were selling goods were absorbing those costs, and now they were ready to pass them on to the consumer. Are there any impacts from tariffs in the read that you have for CPI?
Yeah, certainly there was a big impact, right? If you look at, for instance, the CPI Supercore, it was very strong, 0.6% month on month. Some of that increase certainly reflected tariff pass-through, and you could see that as well in the goods basket. Once you strip out, vehicle prices, it was a significant increase as well. So it means that the tariff inflation story is not over yet. We think that it should continue to play out over the next couple of quarters, but it should no longer be a meaningful driver during the second half of the year.
Okay, talk to me about immigration policy, which has dramatically changed sort of what the U.S. looks like. How is that affecting the cost of goods?
It's hard to tell, really. For me, maybe where you can see it is in overall demand dropping, so maybe on the services side, but it's a little hard to pinpoint exactly in which sector. For me, it could be a story for the housing segment, perhaps down the road. I don't think it's a big driver for housing disinflation just yet, but it could be a driver toward the end of the year or even 2027, right? If people are not coming into the country, they're not going to look for housing. So housing demand will be weaker, and that should be reflected in the slowing rent prices and also OER.
With the CPI read that you have now, has that changed your calculus on the rate path for the year?
Not really. We do still expect the Fed to ease further this year. We just think that the Fed's rationale is moving from risk management cuts and concerns about the labor market last year to a disinflation story in the second half of the year, which, if that happens, it should open space for the Fed to resume easing. We still expect the committee to cut rates by 3 times this year, 25 basis points each in June, September, and December, to a terminal rate that we think is at 3%.
So you think that it will no longer be looking at jobs and weakness in the labor front, that it will move to more inflation, and though inflation has moved down to 2.4%, that will still be the focus?
Yes, so I think just the labor market, and we saw it in the payrolls report earlier this week, is just stabilizing, right? There was a lot of concern about labor market deterioration, particularly since the summer and through the fall. I think the most recent jobs reports, when looking at the household survey, the unemployment rate dropping from as high as 4.6% to 4.3%, I think that basically spells a stabilization of the labor market. So that allows the Fed to focus on the other side, right? The other mandate, to focus on inflation. So if inflation starts to go back to the path of back to inflation at 2%, I think that should open space for the Fed to ease. But we need to see more progress, and we think that progress is probably going to be more visible in the second half of the year, which is where we think the Fed could resume easing.
All right, Oscar Munoz is going to leave it there. So thanks for joining us today.
Thank you.
Coming up next, aluminum fell along with other metals today as traders reacted to a possible reduction in the scope of U.S. tariffs. Back in a moment. Here are the stories we are following in the newsroom today. TC Energy saw profit and revenue for its latest quarter top expectations. Natural gas pipeline deliveries in Canada also rose 5%, setting a new all-time delivery record. TC Energy is also raising its dividend by 3.2%. Enbridge posted fourth quarter profit that rose 17%, driven by expanded operations and lower taxes in the U.S. As a result, Enbridge has reaffirmed its 2026 targets, with the top end of its earnings outlook coming in above expectations. The quarter was also driven by major partnerships with Meta in the power space. Agnico Eagle Mines beat profit estimates in its fourth quarter and saw revenue for mining operations come in above consensus. A bright spot in the quarter was Agnico Gold's output. The company has now surpassed Barrick Mining to become the world's second biggest gold producer. CAE posted total revenue for its latest quarter that came in below expectations. Revenue in its civil unit also fell about 5% and missed estimates. The flight training company says the segment experienced softer order activity. On the upside, CAE is boosting its 2026 outlook for defense. The Trump administration reportedly working to narrow its broad tariffs on steel and aluminum products. That's coming from people familiar with the matter. But the U.S. Treasury Secretary Scott Bessent, today, however, downplaying potential of a rollback. Let's go to Bloomberg News reporter Alicia Diaz. She joins us now. Alicia, what does the walk back mean, or what could it mean for the trade goals for the White House?
This does come into play. It is a pretty remarkable step back from President Trump's very assertive goals that he's been having for his tariff policy over the past year. We've seen a very different sort of rules-based approach this year, or should I say like a lack of rules in terms of not having an exemption process, sort of dictating policy by tweets. And I think a walk back would sort of acknowledge that there are some materials, specifically aluminum, which companies have said is very difficult to smelt in the U.S., sort of saying this is tough for us and we are going to have to come to some sort of compromise here.
Okay, so this, do you think, is coming from political backlash in the U.S. that perhaps is emerging this year?
It's definitely coming at a politically uncomfortable time for the president. Of course, we saw this week that House Republicans rebuked the tariffs on Canada. All this is coming months before the midterm elections. Republicans are very worried about whether they're going to be able to keep power in the House. So this is sort of an acknowledgement that this could be a political risk for them going into November. And this pressure, alongside with the Supreme Court case that's coming, possibly as soon as next week, some other economic reports that show sort of the negative impacts that tariffs are having on U.S. consumers, U.S. importers, that all combined is really putting an extra bit of pressure on the administration.
Could this, do you think, affect CUSMA negotiations?
It's very possible. Of course, the rhetoric has been a very big factor going into the July review or renegotiation process. However, aluminum exports from Canada have been one of the stickier topics. These Section 232 tariffs that are sort of outside the scope of CUSMA or USMCA have been very difficult for Canada to sort of wrap their hands around. And so I think acknowledging that could possibly soften sort of the rift that we've been seeing as to the trade relationship between these two northern partners.
Alicia Diaz is a reporter with Bloomberg News. Thanks for the update. And the latest economic data from the U.S. showing inflation slowed more than expected in January. That is offering some hope that the problem of inflation is easing. We got more reaction today from Andrew Pyle, Senior Investment Advisor, Senior Portfolio Manager, CIBC Wood Gundy.
Given what we saw in anecdotal energy costs in the month of January, given the cold snap in the States, a lot of economists were, anxious that this number could come in on the hot side. It didn't, so that's where your relief rally is coming from this morning. I don't think we're out of the woods, and a lot of people are talking this morning, Lindsay, that this puts Fed easing back in play, perhaps for the first quarter, second quarter. I honestly don't think the Fed is going to change its game plan just based on this one number. There's still a lot of uncertainty in the inflation makeup for the States.
Okay, that was going to be my next question. So you don't think there's going to be a change in terms of the Fed's plan? So how many rate cuts do you think we're going to see this year? I know some analysts are saying 2, some are saying maybe 3 now. What do you think?
Well, we still think you could get 1 to 2, and I think that really is dependent on the fact that inflation has to remain down in these levels or lower, because that's the only way you're going to get 3, 4 or more is if you have either a more protracted decline in inflation, which we don't think is in the cards right now, or in fact you get an outright recession in the United States, which obviously would put the Fed back in the game. I think for now we're sticking with the 1 to 2 rate cut plan for 2026.
Okay, so we'll obviously keep watching that. But of course, we're watching earnings coming in today. We've got a couple of different companies I know that you wanted to discuss. We'll start with Agnico claiming, I think this is interesting, in the latest results from Agnico Eagle, actually claiming the number 2 spot for gold output, knocking Barrick Mining out of that spot. What do you make of what we're seeing from Agnico?
Well, incredible results. Obviously, we're keying off the extremely high price for gold, but I think it's also the fact that we're seeing output increase. And I think that's where analysts are going to be very happy this morning. Obviously, owners of the stock are going to be very happy. We've seen the stock pop. And so they're really delivering on all the guidance that they have given in the last recent while, that they can increase output. They can get those margins to improve with this higher price of gold. And again, a lot of investors are going to sit up this morning, Lindsay, and say, okay, so now second largest company in the world, this really gives you an even more or an even stronger demand push for the stock.
We're also watching Air Canada. Obviously not the best week for Air Canada after announcing that they were going to be suspending flights down to Cuba, obviously because of a fuel shortage there. So not good news for Cuba either. We saw shares of Air Canada go down this week, but reporting a beat in profits, Q3 profit up $296 million from last year. What do you make of what you're seeing from Air Canada?
Well, it's a theme that you're going to see across many different sectors and many different companies, Lindsay, and that is, this shift in travel towards Europe and towards domestic based on what we've seen coming out of the States. Travelers simply, steering clear of destinations that they once would have just gone to and where Air Canada flies to, but now, moving those plans domestically and abroad into Europe. Obviously, you've got the Olympics as well. So, the company is reaping the rewards from that, but we've seen that also, for example, in Airbnb, where we're seeing increased travel demand in those other areas outside of the States. So, I think great results this morning. It's obviously a relief for the company after the, the turbulence, pardon the pun, that we've seen in the stock over the past week.
It is interesting to see some of these companies, like, as you mentioned, Airbnb as well, almost benefiting in a way from what the tensions that are going on between the U.S. and Canada. And I guess that will continue until we reach some kind of deal with the U.S. Is that right? Like, what I'm asking is, will Air Canada and Airbnb continue to be able to offset what we're seeing in terms of that tension between Canada and the U.S.?
I think they can. I mean, obviously, this is hugely uncertain right now. There is no clarity to this situation whatsoever. It's as clear as mud as we sit here today. So we honestly don't know. What we do know is, the traveler's choice in terms of destinations. I mean, when we look at Europe, for example, Lindsay, I mean, this is a high cost area when we start talking about things like hotels and hotel travel. And that's where, again, a company like Airbnb picks up the slack, because travelers are going to look for that experience, but at a lower price point, and therefore they're going to go to the likes of an Airbnb, and that's why I think we're seeing the results that we're seeing.
Okay, we're also watching Applied Materials up more than 11% right now after reporting pretty good results, upbeat sales forecasts. What do you think is contributing to what we're seeing with Applied Materials?
Well, still extremely healthy demand for semiconductors, which is AMAT space. Stock has done extremely well. It's interesting after a week like this, Lindsay, where we're hearing more and more analysts and investors talking about a broadening of a sell-off in tech in general, obviously reaching into the likes of software, that you still find these pieces or these slivers of hope in that sector. And Applied Materials is one of them, where that demand for semiconductors continues to improve. Demand for memory obviously continues to improve, and companies that are in that space will continue to do well, even if you have a general kind of decline in sentiment for the sector as a whole.
And lastly, I know you wanted to talk about Bombardier. I think this is going to be an interesting company to watch in 2026. They beat in revenue and surpassed its 2025 guidance, but maybe, again, maybe some turbulence ahead for this company. What do you think?
Yeah, I think a little bit of a cautionary tale. I mean, the results are great. The market likes what they're seeing, but, we have to deal with the States. We still don't know what is going to happen with respect to the FAA's decision on Bombardier, on planes coming out of Bombardier. So, that's a huge question mark right now. If it gets resolved, I think we're all clear for 2026. But that's one thing that I think is going to keep investors on the sidelines, just to see exactly what happens, what is the future for this company or this company's products with respect to the States.
Andrew Pyle, Senior Investment Advisor, Senior Portfolio Manager, CIBC Wood Gundy. Coming up, Definity Financial reported an earnings beat for its fourth quarter. We'll hear from the CEO in just a moment. Definity Financial reported a Q4 earnings beat after what the CEO calls a transformational year for the company. And we got more from Rowan Sanders, CEO of Definity Financial Corporation.
Very strong fourth quarter to end a pretty transformational year for the company. And we reported very strong earnings growth. The revenue growth accelerated this year. We hit over 9% growth. What I was really pleased about is all of our three main lines of business, personal auto, personal property, and commercial lines, all of them performed very well. All three had really good growth. And we got the operating ROE up into the higher end of our range. So it was a really strong all-around quarter. good quality earnings, and a nice way to kind of exit 2025.
So I was going to ask, like, what drove most of that growth that you saw? But I guess it sounds as though there wasn't just one main factor there.
You know, I think what we like is that there is good underlying momentum in the business. And so each line of business is slightly different. I think in our commercial lines of business, we're getting a combination of price change as well as unit count growth. So that's good. That's also very good for margins, making sure we can hold these attractive margins that we are at. We have great technology, and that's what's really making a difference. If you think about in commercial where the sources of growth are, one of them is in small commercial, and that interaction with brokers, having a great platform that's easy to use, very sophisticated in terms of segmentation and pricing has helped. And in the other areas, we're growing our specialty business, and we've been investing in that for some time. So that line's working well. And then in the personal lines area, I think that, you know, both automobile and property, we're taking share in the marketplace, and that makes us, you know, pleased.
You also have a recent acquisition, Travelers transaction. You described that as a milestone for the company. What makes this deal so significant? Like, what are you hoping to get out of it?
Well, it really is. I think, you know, when we go back to what we're trying to do, we're trying to become a Canadian leader. When we went public just 4 years ago, we were the 8th largest company. We organically grew to number 6 and now number 4 on a pro forma basis with the acquisition. What this does for Definity is we grow at least 35% in terms of size this year. So it's a major uplift in the size and capabilities of the company. And I think that's why we call it, you know, transformational. The other thing that I think is very important is not just size, although scale is really becoming important in P&C insurance, but also capability extension. And particularly when we think about what we got from the Travelers organization, we got a lot of scale in personal lines that we'll put onto our platform, which is a more modern platform. But in commercial lines, they are overweight compared to our portfolio in complex and specialty business. That's difficult, hard to source talent, IP, product, customer relationships takes years to build. So that's a really big addition to our capabilities. And I think that really changes our profile, you know, in the Canadian market. In the broker rankings, you know, for the intermediated segment, we're the 3rd largest insurance company. So we've become even more relevant to our broker partners. And that it really feels like a step change. We're launching the next phase of our growth now.
Interesting. Okay, so you did have a good quarter. You've got a lot to look forward to, but what risks or headwinds are you watching out for as we head further into 2026?
Yeah, look, I think there is good momentum, and in insurance, there's always risks, and I think there are things we pay attention to. Climate change and Nat Cat events can always have an impact on our customers, on our claims volume, and obviously profitability. We manage that very carefully. We've invested in sophisticated modeling, Nat Cat management teams. But also the other thing we're paying attention to is just the general economy. What happens with CUSMA? What happens with trade? How does that affect our customers in commercial? You know, could that slow down a little bit of the growth? And so we're doing a lot of modeling and a lot of alignment around that. We're also introducing some new products that I think address the overall affordability of insurance. And a couple of these products in our personal lines business particularly have really been well received. And that's one of the reasons why we got some late growth in the year, in the fourth quarter. In personal property is a good example. We had double-digit growth. And I think that offering to customers should be well received, you know, ahead. So those are kind of, I think, the uncertainty around the economic environment we're paying attention to.
Which most businesses probably are watching for many of those things that you mentioned. You also increased your dividend this quarter.
Yes.
So talk to me about that. And obviously that shows confidence moving forward.
And that's exactly what it is. I think, you know, as we look about this business, we've increased our dividend significantly since we started as an IPO 4 years ago. Last year was up 70%. This year up 15%. And that does exactly, as you've said, illustrate a level of confidence in the earnings trajectory. Not only are we a growth story and we're growing ahead of the marketplace, but we have good margins, and we're very comfortable we can hold those margins, and that'll produce, you know, compound underlying results. And we're happy to kind of keep moving the dividend, you know, higher to reflect, you know, the earnings trajectory of the business.
Is it difficult to look at, because I was going to ask you about like what does the fiscal year ahead look like for Definity, but with all the risks that you mentioned, right? Like climate change is an ever-increasing risk. It seems like the U.S. could be an ever-increasing risk to Canada. Is it difficult to kind of paint a picture of what your forecast is going to look like for 2026?
No, I think we're pretty stable as an industry. One of the things about insurance is that there is a fairly inelastic demand. And so even if we do get into tougher economic times, on the top line, on the margin, will have an impact. But people still require the ability to insure their homes, insure their cars, insure their businesses. I think we've just given some guidance, and our guidance really is that the underlying Definity business continues to grow really well. We will, of course, bring on the Travelers portfolio this year, and that will be kind of a flat portfolio as we onboard it, as we convert the policies and the products and the customers from the Travelers portfolio onto our platform. So I think we're pretty comfortable with where the revenue is. And again, there's good underlying profitability. We're pretty cautious with the risks we take, how we structure our reinsurance programs. So whilst there's always a little bit of volatility in an underwriting company, I think that we've demonstrated we can manage tougher cycles as well as good cycles.
And just quickly before I wrap things up, how quickly does it take for you to transfer that Travelers portfolio onto your platform, as you talked about?
The full integration is about 3 years when you actually think about earning all the margins that we get out of it. And we found a target of about 100 million of cost synergies we think we will get. But we'll be starting middle of this year in terms of the conversion process. And roughly it's a 12-month process to migrate the majority of the customers onto the Definity platform.
Rowan Saunders, CEO of Definity Financial Corporation. The U.S. House of Representatives passed a resolution against U.S. President Donald Trump's tariffs on Canadian goods, delivering a message to the administration for launching a trade war against Canada. CTV's Rachel Aiello has more on that.
The joint resolution is passed.
By a vote of 219 to 211, the U.S. House passed a resolution to repeal President Donald Trump's so-called fentanyl tariffs levied last year, citing border security. These 6 House Republicans breaking ranks to join the Democrats in backing the move.
This is the right vote for my district. These tariffs are hurting them, and again, that certainly weighed in my vote on this.
Well, I've got to represent my district, and Canada and the state of Washington have very close trading relationship. It's valuable.
And while largely symbolic, it's a sign some Republican support for Trump's use of emergency powers is slipping.
I think it's an early indication that over the course of the next 6 months, we're going to see a little more month-by-month erosion in the support for the president among the Republican caucus, both in the House and the Senate.
Defending his trade agenda, Trump said any Republican in the House or the Senate that votes against tariffs will seriously suffer the consequences.
I'm disappointed in the vote, but the president has veto power.
The resolution now goes to the Senate, but without the 2/3 majority needed to override Trump's expected veto, the tariff policy won't change.
So it's a good step, but it's a small step.
Still, experts say it positions Canada better heading into the CUSMA review.
I think it actually gives Canada a little bit of additional negotiating power, right? But it just highlights to the president and to the U.S. administration that Canada has allies here.
The U.S. Supreme Court is separately weighing whether Trump can continue to use these emergency tariff powers.
Rachel Aiello is reporting there. Coming up, shares of Manulife got a boost today after they beat estimates in the latest quarter. We'll hear from the CFO. That's next. Shares of Canadian insurer Manulife got a boost today after reporting a jump in its fourth quarter core earnings and announced a 10% increase to its dividend. We sat down with Colin Simpson, Chief Financial Officer at Manulife.
We were really happy with our numbers. We saw earnings go up by 5% and on a per share basis up by 9%. We felt so confident in our outlook, we increased the dividend by 10% and announced a new share buyback of 2.5% of the company. So things went really well for us in the quarter. I think the reception to the results and the results in share price decline, some of that was due to softer Asia sales than we've seen in the past. And we'll always prioritize value over volume. So, we certainly weren't concerned with our Asia numbers. And in fact, Asia earnings were up 24%. The other area that got some questioning on the call was we saw $9.5 billion of net outflows in our asset management business. But this was largely a function of what we're seeing in the market and some very seasonal retirement fund flows. So when you put that to one side, really strong earnings growth out of our asset management business. So feeling really good about the quarter and looking forward to the near future, really.
And I don't want to take away from the positives of this report, but you did mention, sales in Asia, sales in Hong Kong in particular were down in Q4. Despite strong performance throughout the year in Asia. So what do you make of that? What drove those sales being down, do you think, in that quarter?
Yeah, and we saw in Hong Kong, we sell through a variety of different distribution channels. So we have our own agents that sell our products. We have banks, and then we have independent agents. And what we saw this quarter was that independent agent channel having a tougher period for us. And part of that is there's been some regulation change. And so there was a little bit of disruption in that channel. Now, the important thing to note is that our own proprietary channel and the bank channels have higher margins. So while sales were down in Hong Kong quarter over quarter, margin was up really strongly. Actually, we had a 52.4% margin. A year ago, that margin was 39.7%. So when you take a step back, actually, and look at the overall sales growth in Hong Kong for the full year, it was up 21%. And that sort of demonstrates that the comparator was quite tough for our Q4 numbers.
Manulife also announcing that you're launching ETF-based mutual funds. Tell us more about that and what investors can expect from that.
Yeah, we want to be the number one choice for customers. And so our drive is to provide customers how they want to invest, what they want to invest. We want to give them as broad an opportunity as possible to invest. And ETFs are a core part of our product offering. And in fact, through John Hancock, the brand that we trade in the US, and through Manulife in Canada, we're able to offer ETFs to give customers that extra choice. When you look at what we offer as a company, we go all along the credit, equity, and infrastructure spectrum. We've got a fully illiquid private credit business that we offer through our Comvest Credit Partners. We've got semi-liquid through CQS based out of London. And then we've got the broad-based Manulife funds that offer public credit with a fantastic track record. So you put all that together on top of really great infrastructure opportunities, and you add the option for customers to invest via ETFs. And we think Manulife is a fantastic option for our customers.
You also announced a new global credit strategy, a couple of announcements yesterday. So tell us more about this strategy.
The global credit strategy, look, there's no real change to global credit for Manulife. We remain very constructive, and we pursue a diversified strategy. We operate in in 14 different countries in Asia. So having people on the ground really gives us that opportunity to assess credit as it happens on the ground, gives us great knowledge locally, and you put all that together, and we remain relatively constructive on the credit space. We do think that the economy will not necessarily struggle too much in 2025, 26, but it's certainly not going to be, a blowout year. And so things like the short-term interest rate, we expect it to remain fairly constant until well into 2027 here in Canada, and that's really reflecting a credit environment that will continue to muddle along, I think.
Is that one of the headwinds, if you want to call it a headwind, that you're anticipating in 2026? I was going to ask you what challenges you see lie ahead for Manulife, and the economy kind of, as you say, like muddling along, maybe could be one of those potential challenges?
Yeah, the great thing about a life insurance company is that a lot of our earnings stream comes from business that we've already written. And so, when you think about some of the challenges, some of the macroeconomic challenges and the geopolitical concerns, that doesn't really impact our earnings per se. But should we see leakage of that into the credit markets, certainly I think the whole financial services sector could see that as a challenge. But I will say, we operate really in the public credit space, so quite high up in the quality spectrum. And in fact, we had a really good credit experience in the fourth quarter, and that's reflective of the fairly benign credit environment, particularly in the public space where we operate.
Colin Simpson, Chief Financial Officer at Manulife. A quick recap of how we ended the week here in Toronto. The TSX bouncing back 608 points today after dropping almost 800 yesterday. So it was up back 1.9%, we'll say, and above 33,000. A couple of big movers in Toronto today, including Magna, maker of auto parts. It wasn't so much the report for the latest quarter. It was really the fact that their outlook looked strong. And that brought the stock up almost 19%, a gain of $14.89 today to $93.52. Got to leave it there. Thanks for joining us today on The Close. We'll see you back here again on Tuesday.